10-year note yields remain stubbornly low. Today trading below 2% yet again, but not seeing any extension to that trade. We saw overnight geopolitical risks arise. We've seen, trade rumors back and forth about how this is all going to come out, or if it is going to be settled at all this weekend. And I think at this point now, the market just seems very, very trigger happy to be buyers. So you continue to see the buying press even as yields go lower and prices go up. Buying gets more aggressive. We see modest retracements on any news because I think everyone wants to sell this market. It's been bidding for so long, and then it is quickly bought up again. So I think from a technical perspective, yes, this looks like it could be a good place to sell right around 2% because we've been unable to break away from it. I think the key level, which has been and will continue to be 185, that's where this all began, this rally in yield way back in November of 2016 on the election. That's where we were trading, and we have yet to retrace fully to that after going from 185 to 3.25 and back to where we are right now. So I think at this point, sellers beware, because yes, we do see modest upticks in yield, but we haven't seen a sustained uptick for quite some time, and they may be traps. So at this point, let's let the dust settle. Can we get to that 185? Then I think it's time to start looking at selling when we get at least to that level or close to it. And if you look at market volatility, it remains elevated, but it's off those highs that we've seen recently, but hugging up very nicely to that 14-day moving average, which also continues to creep higher, obviously, as we make higher highs in implied volatility. So at this point, I wouldn't say it's quite a fear gauge like we talk about with the VIX index, but it certainly measures concern and something that we've been now tracking for several months, and it's unlike something we have seen over the last 10 years. So we've got a long sustained period where there is concern, and yes, it's about trade, yes, it's about geopolitical risk, yes, it's about domestic policy here, whether it be from the Fed or from the economic data we're getting, and there is a lot of concern out there. And the buyers that we've seen in the bond market continue to buy with both hands, and when the market goes in one direction for a very long time, that tends to see volatility come off. Not when you're making new low yields and new high prices continually almost day after day. So yields remain stubbornly low, buyers are still out there, demand is still very high. And lastly, let's talk about some of those Fed speakers we got today. Fed President Bullard was out, and so was the chairman, Jerome Powell. He was out speaking as well. And I both wanted to kind of give the market a let's calm down, let's take it easy. Mr. Bullard first talked about a 50 basis point rate cut would be way too aggressive at the July FOMC, while the chairman reiterated his comments from the June FOMC last week, saying that the data will dictate policy. And I think at this point, the market is so overwhelmed with the positive expectations of rate cuts that the Fed wants to talk itself back a little bit, but without maybe taking any or all rate cuts off the table, at least because it doesn't really know how this is all going to play out. Certainly, we're going to get some information globally from the G20 this weekend, but those Treasury yields continue to go down and Fed fund expectations continue to go up for more cuts. So right now, the market is still very, very tilted to one side, and the Fed is still playing catch up. So maybe these Fed speakers today wanted to maybe try and bring the market back to the Fed. It worked for about 15 minutes, and then things went right back to where they were prior to those two gentlemen speaking. So right now the bond market remains very well bid, yields remain very low, and not even the good chairman himself could talk back more rate cuts, which likely are coming in the weeks and months ahead.